Thank you for tuning in to another great video by Destiny. Over the years, Margaret Lomas has answered hundreds of viewer questions about many aspects of property investing. Here's one of them.
Hi Margaret, if I stayed in my home for 3 years and then sold it 10 years after moving out from it, how would I work out the capital gains tax? Would it be 4/13ths, or can I get a valuation after the 6 years is up and calculate the gain from that date and pay the tax on the difference? I think the ATO website seems to deal with the first method. Is method 2 also possible? My 6 years is up in a year's time and I'm contemplating whether to sell. Joyce, this part of the tax rules can be very confusing and can be really hard to wrap your head around. Where tax is concerned, it's really important that you contact an accountant, tell him or her your exact situation and ask them just how the rules apply to you and what you'll pay. Now you can choose to treat a property as your main residence even after you move out, providing that you don't choose another property as a main residence during that period and it's not rented. This means that if you didn't own anything else and you didn't rent out that property, you can keep the main residence exemption on it indefinitely and pay no capital gains tax. However, if you did rent it out, the maximum period that you can treat it as your main residence after you move out is 6 years. You can move back in during the 6 years and then the 6-year period will reset. If you continue to own the property after the 6-year period has expired, you only get a partial exemption. In your example, if you lived in it for 3 and then rented it for 10, you would have to pay capital gains tax on 4/13ths of the gain. You can't use a valuation after the 6 years for the basis of calculating the capital gain, but you are able to use a valuation at the date it ceased to be your main residence. In your case, this was 3 years after you purchased it. The capital gain would then be calculated as 4/10ths of any gain over that. Now you'll need to get a qualified valuer to provide you with that retrospective valuation if you don't have one from that time. The ATO is unlikely to accept a market opinion from a real estate agent where no valuing qualifications are held. Again, I stress you need to discuss this with an accountant who has a good grasp of capital gains tax and main residence exemptions.